Okay, guys, we are here to try to understand what is going on with the banks around the world. I don't know about you guys, but I've had a hard time really keeping up with everything. And so what I've decided to do was bring two of the smartest minds that I know in the crypto and economic space tonight on this interview, or this let's just call it a fireside chat. We have Brijesh Patel, who is the managing director and partner of Master Ventures Investment Management, our LP fund. That's a $20 million fund. We're having a really great year so far, have implemented some great strategies. Brijesh, thanks for coming here. Is there anything else? Maybe you could just do a quick introduction about yourself.
Sure.
Also, very, very important. Yeah, well, I mean, you could say it too, but you know, Pronomos, super impressive. Peter Thiel invested fund. Maybe you could share more about your background.
Sure. Yeah. So my background is in quantitative finance. So I've kind of been through the TradFi matrix for about 10 years. I always kind of knew that wasn't for me. Found my kind of connected with my entrepreneurial spirit maybe about 15 or 20 years ago. Started two startups in kind of the Web 2 economy. Left my job in 2011. I started investing in Bitcoin in around 2014, only because Mark Andreessen was talking about it at the time, and I trusted him. And this is how far away from the knowledge of what Bitcoin was and what money was I was at the time, despite being in finance. In 2017, I exited one of my startups, started traveling the world, started meeting people like yourself, Kyle, from around the world who were working on crypto projects that were well in advance culturally versus the US at the time. And in 2019, I worked with Patrik Friedman at Pronomos, which is a charter cities venture fund. And the interesting thing to me there was that a lot of our LPs were people who had done really well in crypto. And I feel like when people do well on Wall Street, they buy bigger houses and bigger boats. But when people do well in crypto, they try to buy bigger freedoms. And that was kind of like a re-permissioning for me at the time to be able to begin to think about how somebody would design new cities if they could from the ground up. I've lived in the Northeast, in New York City and Boston for a long time. These are 300-year-old cities where the parking sucks, public transportation is stressful, and you just kind of accept how everything is. And so it wasn't until I stepped outside of that and began hanging out with people who were thinking really big on how to redesign our world, that I started to connect all the pieces on this. And then, Kyle, you and I met in Kopangan in 2020 when you were looking for support in setting up a fund. And so that's kind of what brought us here today. So for me, in a nutshell, like I'm kind of a generalist, and I've been through like various experiences that wouldn't necessarily make sense if you just saw them on paper. But for me personally, they're reconnecting in this really powerful way. Like these past 2 weeks, I've been recounting how I was processing the 2008 financial crisis when I was working at an institutional bond manager designing fixed income risk models in like 2007, 2008. And at that time, we didn't really have Twitter. We barely had smartphones. And I think everyone was kind of glued to the TV and glued to CNBC. And so it's just wild to see how many generations of evolution we've had since then in the way that we both like share and process information on this.
Yeah, absolutely. And one more thing I want to mention about your past experience. For those who aren't aware, Patrik Friedman was something that I looked up to as a role model in his way of thinking, where Patrik Friedman was the founder of Seasteading Institute. And Seasteading Institute, for those of you who aren't familiar, I definitely encourage you to go Google it and check it out. It's an amazing idea. One of the things I've been thinking about for a long time is how do those of us who choose or would like to experiment with different governance styles, how do we do that? You know, because every single piece of land on this planet is occupied by a nation state that they're just not willing to part ways with, right? And I mean, to some degree, maybe if you have a big enough bargaining chip, and that's what Pronomos is working on, right? Pronomos is working on, you know, how do we work with governments to give them some value, so they would be willing to give us a piece of land and protect us in case we were invaded or something, right? But otherwise, other than that, leave us mostly alone and give us full autonomy to, you know, govern how we please. And so that's a really inspiring idea. And Seasteading Institute was working on, well, if we can't do it on land, let's do it in international waters. And how do we build seasteads, or basically cities out in the middle of the ocean, where there is no governing law, and we can create our own nation states with our own experimental governance structures. And that, to me, was really appealing, because I am not a fan of the current governments around the world. They're all corrupt. They're all centralized. They're all corrupt to some degree, for sure. Like, I don't think anyone would argue that fact, and most people don't trust them anymore. And we would be looking at a dramatically different world if we had a world where nation states didn't have borders that we were bound to by birth, that we could choose opt in to claiming citizenship in that country, and also have the freedom to leave without taxation, without penalty, whenever we wanted to, if we felt like we weren't being served according to what we were promised, right? This would be a radical shift in the way that our world is if governments were competing for competing for population, competing for people to come and saying, hey, come to us. We have the lowest tax rates. We've got the best benefits. We got this and this and this. This is how it should be. The government was meant to work for the people, and it just doesn't anymore. And so that's why Patrik Friedman and the whole Pronomo story and you, Brijesh, were so inspiring. And I'm so excited to have you as part of the team, because like that is, like you were saying, big thinkers. And this is, where I'm thinking all the time is like, how do we make the world a better place? And not just by like making some stupid new law in the United States, which really isn't going to make a big difference. We're looking at massive paradigm shifts. Is what's going to take for us to really evolve as a human species. And so I love people like that, and the people like you that are thinking really big. So thanks for being here. We're looking forward to hearing your thoughts on the banking situation. Rodrigo or Roderick. Roderick has been with me for quite some time. He started working with us doing token economic designs, has a really impressive background in economics, very smart guy, built some of the best token economic models I've ever seen, and is now doing his own thing, and I'm fully supporting that, and has his own YouTube channel. I highly suggest you go check that out. Token Design is what it's called. And Rodrigo, if you want to add any bits and pieces in there, like your recent interview with the El Don of the UK.
Yes, master rule bender and breaker, Boris Johnson, the ex-Prime Minister of the UK. Yeah, that was an amazing opportunity. He was speaking at a blockchain conference, and putting any controversies aside, I thought it was an extraordinary opportunity to speak to someone who's taking these amazing big decisions, and then the UK made some moves to sort of like start accommodating blockchain and crypto technology. So it's just really good opportunity to sort of like say, why did this start appearing to be interesting? Speaking a little bit about my background, I've always been someone who's been passion motivated as well. My first calling was actually in the renewable energy space. I worked in renewable energy finance and took part in these very large deals to provide debt to build renewable power infrastructure and win commercial contracts from government that would support the development of $1 billion worth of new wind farms out in Chile. So my role in that was being the geeky guy who would get into spreadsheets and build these monster models. So people would sign off on hundreds of millions of dollars at a time to say, okay, we're behind this. But that was in a corporate culture that I didn't enjoy too much. So I quit. I went traveling around the world, and I started teaching, creating courses online, and those gave me a bit of a passive income and I started living as a digital nomad. And the beautiful thing was that just freed me up to sort of float around. And then along the way, I meet you, Kyle, and that was an extraordinary opportunity because my bias or my habit is on the other side. I was sort of like a little skeptic, a little unsure about crypto. And then meeting you, you gave me this amazing opportunity, and I started taking a closer look. And then my mind was blown because, like I said, I'm someone who's motivated by, inspired by the ambition of making a change. And going to study economics is a funny thing because if you based on what's taught in universities, they do a really good job of saying, this is why everything's difficult. This is why everything's messed up. And this is why what we have is kind of like the best we can do. And then, I'm looking at all this stuff. And then suddenly I'm just thinking all the way back to all these university studies I did. And I'm like, hold on, wait a second. We've just been given a completely brand new toolbox to address these long-standing issues with that I was taught we could do no better to improve upon. So that's been really exciting for me. And to be honest, I'm sort of on my own journey at the moment. I'm trying to create thought leadership and define what these problems are around good tokenomic design. I think I'm still sort of like a little bit boomer. Let's say I'm building the bridge from the other side. I'm happy to believe that regulators and governments have a positive role to play in this story, in this evolution and transition to a new internet-based economy built on blockchain. But I don't think they're all bad. And when I speak to them, I got to speak to some of them at this conference where I interviewed Boris. I hear them getting excited about some of the exact same things that you do. They just have a different vision and a different belief about how to bring it about. So yeah, I think that's a fair summary. Thank you so much for having me on here.
Yeah, so let's talk about this, because I'm not really sure how I should be feeling right now. The fact that part of me is getting really excited that we might see something like hyperinflation. Balaji is betting on it. $2 million that next 90 days you're gonna have Bitcoin at $1 million due to hyperinflation from the US dollar. And whether he's right or wrong on the time frame, I certainly think he's right. Inevitably, right? And whether that's 90 days from now or 9 months from now or 5 years from now, but it's going to happen. But if he's right, or when that does happen, that's probably means that a lot of the world is going to suffer, right? Because there's so much wealth in US dollar, and if it starts inflating at 50% a day, pretty soon, or even 10% a day, or even 1% a day, what happens? That's crazy. Like what's going to happen, and if it's slow, maybe people will have some time to take retreat into Bitcoin, but this is what it was made for, essentially, right? It was literally, it was released just after the 2008 collapse. The very first block produced talks about the banks abusing their power and being bailed out. And here we are again, and what's going on right now? Is this just 3 small banks that have gone down? Signature, Silver, what is it? Silver Bank, Silver something, and Silvergate, and then SVB. So I know there's some news about Credit Suisse, but to be honest with you,
I don't. Over,
yeah,
as well by UBS, yeah.
And so I'm not too up to date with what's going on. So I'm asking you guys, like, what is going on, and is it over now, or is it just getting started?
It's not over.
It's not over. It feels like it's just beginning, and it might be good just to go back a couple of years just to kind of see where we came from. The real place to start is 2008, 2009, right? Like at the birth of Bitcoin is kind of a good place to start to try to understand what state and what structure the banking industry was in at the time that allowed Bitcoin to be born, and it was way ahead of its time. I think any of these ideas that are like big world-changing ideas really take time to percolate, whether it's starting new cities or starting new money. And from 2009 onwards, we kind of enjoyed this low interest rate environment for nearly 10 years, right? And it was, all of like the investment industries were coming up, the stock market was doing well, money was accessible. And in 2018-19, I think they started to raise rates a little bit, because you kind of get the sense, like if you're running things, that maybe the party's about to be over, right? We've cyclically had like these kind of 10-year cycles, 10-year boom bust cycles. So around 2018-19, they started tightening. And then 2020, the pandemic hit, which, by the way, arguably Balaji may have called in January. It's just really interesting to see this stuff in hindsight, which is what makes his bet so intriguing today. So in Jan of 2020,
can you explain that a bit more? What was his bet that you're talking about? Yeah.
So his bet currently is the hyperinflation, hyper Bitcoinization bet. But in January of 2020, he was sort of on the cutting edge of doing research and understanding what was happening in the sort of panic of the pandemic. And then if you go back and read his tweets from Jan of 2020, and in hindsight, he was able to methodically distill some of the best information and like put together the story in like rapid urgency that in hindsight makes a whole lot of sense, to his credit, right? So anybody who like follows him or listens to him knows the depth to which, like how deep and methodical a thinker he is, and how well read he is, and how well studied a student of history he is. So I think it's at the least a really important time to pay attention to his bet, because in 2020, at the start of the pandemic, the Fed went full on back into QE and printing money, and we printed something like $4 trillion. And so what happened during that period was, when there's a lot of money in the system, people are much less scrutinous about how they invest and how they spend. So it accumulates in funds, it accumulates in bank accounts and as banking deposits. And in a low interest rate environment, what has to happen, especially at the regional bank level, is these banks need to be able to compete to keep your deposits. So if interest rates are super low and you're not able to earn money, meaning society is encouraged to spend money and to keep money moving, right? The velocity of money increases. Then a bank like SVB has to try to find 2% yield on their savings account in order to keep your funds there. Now, SVB specifically, founded in the 80s, catered specifically towards startups, where the average account size is pretty large, right? Like, I think the average person on the street may have a couple grand or 10 or 20 grand in their checking account. But if you're a startup founder who just raised a $5 million Series A, you're looking for banking services, and you're already risk on. You're already risk on with your money, with your energy and your time. You're building a startup, 9 out of 10 fail. You don't really want to be thinking about what to do with your cash to keep it safe, because you're funding a burn and you're paying for your employees and paying for your expenses. So Silicon Valley Bank had kind of found a niche in serving startup founders and Silicon Valley venture investors, to be able to give them all the types of things that they would need that perhaps a larger bank wouldn't be able to cater to them, right? So things like venture debt, or just certain types of services, and the fit and finish. Like when you'd go to open an account, they would open a nice bottle of wine with you, and they could really talk the talk. I met some SVB bankers back in 2013 when I was raising money for my startup, and the experience was like a cut above the rest. Whereas in Bank of America, I just wasn't treated very well. In SVB, they understood my struggle. So they had this super high concentration of venture money. And when you're depositing $5 million, the difference between a 1% or a 2% savings account is huge. That's one person's full-time salary per year, right? In the interest that you're earning. So in order to produce that kind of yield, what the bank does is they take your deposits and they invest it in presumably safe market securities. And usually the way they do that is they buy either treasuries or other asset-backed securities like mortgage-backed securities, et cetera, or loan portfolios. And normally what they would do is they would try to buy the shortest duration, meaning the shortest sort of contractual timeline loans that they could get away with, so they could continue servicing your deposits, right? Because if you have a bunch of startups that are slowly burning capital, then that deposit base over time is going to go down.
Could you explain a little bit about what a bond is?
Sure. So a bond is a financial instrument that is a fixed income instrument, meaning you are paid a certain amount of interest over a fixed period of time, and then you're returned to the nominal value, the par value of the bond at the end of the term. So the point of a fixed income instrument is that it is a debt-based instrument. And if you are trying to match your income with your liabilities, and your liabilities are relatively fixed or understood, then it's an optimal instrument, because it's very easy to predict what the cash flows will be. Whereas let's say if I had a monthly living expense and of $1,000 a month, and I had $12,000 to invest, and I didn't want it sitting around in cash, if I went out and bought Amazon stock, which is an equity instrument, it would be very difficult for me to predict the amount of liquidity I would have throughout the year in order to pay my bills every month. But if I buy $12,000 in bonds that return $13,000 in total by the end of the year in payments of roughly just over $1,000 per month, that's much better matched to what my liabilities are, right? So I can reliably expect my $1,000 check coming in every month that goes to my expenses. Mm-hmm. So that's why a bank like SVB can't take your deposits and go buy super risky assets, but they do still have to produce yield, which means it's not just sitting there in cash.
So these bonds, who's selling the bonds, or creating the financial instruments, and what are they doing with the cash?
Sure. So the safest bonds are sold by the U.S. government, which are, like the US dollar being the reserve currency, those are the sort of the safest debt instruments in the world, because the US can always just print more money, right? And it would be very unlikely and very bad if the US defaulted on its own debt. Although that has happened before, but that's a different story. So that's the safest. And so, because it's the safest, it offers the least amount of interest, right? Mm-hmm. So if you are interested in getting more interest, then you have to start sort of dip into more riskier stuff. And an example of that is mortgage-backed securities, which actually relatively are still not very risky, because it's basically a pool of mortgages, or a pool of expected mortgage payments distributed across many different mortgages and homes, and that are collateralized by the homes themselves. So if you have an individual who's unable to pay, the bank will foreclose on their home and make that loan whole. And so there's a little bit of like interest rate risk there, because if rates rise, people have a harder time paying their mortgages. Mm-hmm. Maybe you have more defaults, especially if you have the kind of thing that happened in 2008, where a lot of those mortgages were bad. So, and as a result of that heightened risk, you get a little bit more yield, which is again very appealing to an SVB, because they have to try to produce 2% on those deposits.
Yeah, they have to try to be, not only do they have to wine and dine you to get your business, but they also have to outperform the classical Bank of Americas and Wells Fargo's and these guys, right?
One of the interesting points and ironies of the situation with SVB is that it blew up not because they started going into those riskier mortgage-backed securities, but it blew up with them invested in the safest securities, quote unquote, in the market. Now, to understand this again, we need to understand what mindset we've been left with by the 2008 financial crisis, which was predominantly a crisis about credit risk and liquidity risk. Because everyone was investing in these super risky mortgage-backed assets, we got to a point where the banks no longer knew who had money and who didn't. Okay, so the regulatory response was to say, okay, if you're a bank above a certain size, you have to play by some rules. Your balance sheet has to hold a certain fractions of certain types of assets in order to offset your liabilities. So one of the categories are high quality liquid assets, HQLA. Mm-hmm. And the assets that qualify in that category are U.S. debt, U.S. bonds, right? Now, what happened with SVB? SVB actually successfully lobbied to have some of the regulations, the Dodd-Frank regulations that were a response to 2008. They successfully got lobbied to get those relaxed under the Trump administration. So that gave them a little bit more leeway. But even then, what they did was, there was, I don't know if you guys noticed, but there was a lot of money sloshing around during COVID, and tech did really well.
Yeah, I think so, everyone, the entire world noticed there was a lot of money sloshing around during COVID.
So their deposits suddenly go up enormously, and what they decide to do is, okay, we're going to play it safe, but we want a little bit more yield. So one of the ways you get more yield with a safe class of assets is to lock up your money for longer, right? So you buy a longer dated bond. And that's all fine. But what started happening is that in this higher interest rate environment, everyone's stuck with their cash accounts and saying, this sucks. I can now get more interest from a money market fund. So they start pulling out. And then there start being some jitters. And actually, there were reports. BlackRock told SVB that their risk controls were inadequate. JP Morgan did an analysis on their balance sheets and said this isn't looking good, because what happened was that because they locked up this money in longer term treasuries that were 10 years or longer, if depositors started to pull out their money, the only way they could pay off those depositors was to sell these treasuries. Mm-hmm. And because they are selling long-dated treasuries in a high-interest environment, and remember, Brijesh said these are treasuries that don't pay much interest, in the current market, they're sold at a loss to the original investment value. So this balance sheet is no longer good to match the value of the liabilities, and they got caught with their pants down. And the problem was that all these regulations were looking at at credit and liquidity risk, but this time everyone's being caught out by interest rate risk. And I personally find it a little bit, I find it very surprising because the tech crowd seems to be, they're all catastrophists and talking about how the world's going to end. And we saw this mountain of money, and it's just surprising. And everyone knew that inflation was going to be around the corner and that interest rates would rise. And yet the people running the show decided, no, let's park it all into longer term dated treasuries. The other thing that's unusual here in the SVB story is that the investor base is really concentrated. So everybody, tech got hit really hard on the way down. So everybody was reacting and pulling out money at the same time. And sort of like the fact, whereas a bigger bank may have a more diversified pool of customers, right? They won't all be going to the bank. They won't all be exposed to the same stresses. That was the thing on the liability side that concentrated risk for SVB. So these two things came together: the tightly knit, very homogeneous group of depositors, and the fact that they just parked this giant ton of cash into assets that no longer are being valued in the high interest environment.
And what happened to, and why is it that the Silvergate and Signature were targeted as the first two to come down? It sounds like this is a systemic type of issue. I mean, it sounds like the smartest thing for a bank to do with deposits was to buy the most safe instrument, which was bonds. It sounds like bonds are now not worth what they used to be, and they're not marking those down into market on the day, the value that they currently are. They're doing long-term valuations of these things. So it seems like this would be systemic, global risk for banks.
This is the entire point of higher interest rates from central banks. It's to make money expensive. And what do banks do? They're in the business of lending money. And if their entire business models and thinking have been structured around a generational bias of a low interest rate world, they don't know how to handle what we're in at the moment. But I think the Signature, the Signature case, they had exposures to FTX. There was actually some bad loans and bad exposures in the mix, which SVB didn't have. So I think the stories are slightly different, but they are all being hit by this rising interest rate environment that is essentially making business more costly for banks and different, and asking them to operate in an environment that's different to what they're used to.
I think it's also important or interesting to look at the decision process behind upper management at banks and how to deploy these deposits into different yield producing securities, right? So if you think about it from the perspective of the CEO of a bank who in 2020 or 21 is flush with deposits, which is great news because it means you have a lot of customers. And now to start producing yield, the first thing you're going to ask yourself when you're deciding how much duration or interest rate risk to take is, what is my expectation of what the Fed is going to do, right? Like what is the expected interest rate environment? And I think arguably in their defense at the time, the Fed was telegraphing that we're not going to raise interest rates for a very long time. So these decisions were made at least on some basis of information that's like, okay, it seems like, like with the pandemic being open-ended, not understanding the effects, all the like downstream effects of supply chain and unemployment and all these, we're going through a world-changing shift of people working from home, all this stuff, right? So it's like, okay, we don't know how long this is going to play out. We don't know if there's going to be further waves or if it's going to mutate or what's going to happen. It's fair to expect that interest rates are going to stay low for a long time, but which, by the way, they have for the last 10 or 12 years, right? So if you're a bank CEO trying to make a decision on how to remain competitive in the meantime, your time horizon is quarterly. And the reason it's quarterly is because you're a publicly traded bank with shareholders who are demanding dividends or performance on their stock every quarter. So it's really interesting to take in, if you just start to see the different incentive timelines for the Fed, it might be on like a like an election cycle, maybe 4 years or maybe 10 years, which is like, probably a Fed chairman career cycle. And then below that, you have the banks who are sitting really working on this stuff on a quarterly basis, right? So if you're a CEO, you're incentivized to do well now, to produce yield on your deposits, to draw in customers, to have your bank business run well. And if it runs well, then you get paid and your shareholders get paid. And if you're backstopped, if it's fine to be buying longer duration securities, especially, by the way, because there's this accounting rule that allows you to mark them as held to maturity, which means, as Roderick was saying, if you bought a $100 bond at a low interest rate and rates go up and that bond is devalued to $90, you're allowed to call it a $100 bond still on your books as a held to maturity accounting practice, not a mark to market. And if these things are mark to market daily, then you'd have a huge problem because the bank's balance sheet value would swing wildly, right?
Yep.
So if things are chugging along and you're like, oh, we're good because we're just holding to maturity, and as long as we can weather the interim withdrawal demands, then we should be good, because if we just hold these things to however long our duration is, 7-10 years, we'll be able to pay everything back. So if you're running a bank and kind of these are your incentives, it's easy to feel like you're doing the right thing at the time because your shareholders are making money, your depositors are happy, and the money is quote unquote safe. But it's not until they start raising interest rates. And the last thing I'll say is the thing that kind of came out of nowhere was the Russia-Ukraine war last year, right? Like, just thinking back to how innocent we were in January of 2022, kind of coming out of the pandemic. Maybe we were running up a second bull market in, equities and in crypto. And then in February, this thing escalated I think faster than anybody had expected. And that really threw a wrench into the interest rate thinking.
Yeah, gotcha. Let's go into there seems to be from the White House, Washington area, some emphasis of pointing fingers at crypto for what's going on. Can you guys explain why that's happening? It sounds like this is this is really just central banks, centralized banks doing what banks do and being irresponsible. But what do you guys have any opinion on the crypto influence here, and maybe how what happened with USDC and people pointing a lot of fingers at these kind of things and screaming for regulation? And is this just a ploy for reinforcement for the central bank digital dollar, or what's going on here?
In the press I'm reading, I've been following these stories mostly through the Financial Times, and they're not putting a crypto angle at all. Whenever they mention signature, they do talk about crypto exposure. USDC got its story on depegging, but they are the way that the mainstream financial press is leading these stories is bank mismanagement. There's not in the stuff I'm reading. There's not a strong finger pointing narrative at crypto. It's literally just being mentioned in the signature case.
Can you explain to me this tweet that I've seen on a couple different accounts now, which says several major banks announced coordinated action to increase U.S. dollar liquidity provision in the global market through swap lines. And then you've got U.S. Federal Reserve, Bank of Canada, Bank of England, Bank of Japan, Swiss National Bank, and European Central Bank. What does this mean?
There is a crazy chart doing the rounds at the moment, and it's the number of banks that are going to the Fed to access very short-term debt. I think it's called the discount window. And if you look at the chart, there's some sort of normal but extreme movement up in the run up to the pandemic. It looks like a triangle. And if you look at the chart, and then it sort of goes back down and stays there. And then last weekend, it just goes like this, boom. Sorry, my finger's off the lens, but it just bounces right back up to where it was in 2020 in one day without this sort of little accumulating and decumulating pattern. So there is a lot of stress at the moment around bond markets and this need to sort of shore up liquidity. There is a lot of activity. Everybody wants to believe that banks are in a much better position, but as I was saying earlier, the defenses that people have put up are very much geared towards saving the world from the last war, from the last event, and this one's a new one. and the way we tried to defend ourselves has left us completely unprepared for the battle we're facing now. So yes, people are scrambling around for money. It's unclear, the fact that other large banks like UBS brought out Credit Suisse. It looks like the bigger banks are still okay. They are being proactive in putting out credit lines because they know that they have to be seen to be doing something. It would be politically unacceptable to have a broad bailout. And if they are active bailing out these small banks, that stops, that hopefully contains the issue and stops the dominoes falling and everything becoming a bigger problem.
You had kind of asked, like, how does this affect crypto, or what is kind of the public statement or admission around crypto? And obviously we've seen SVB go bankrupt and shut down. And then there are two crypto on-ramp banks also went down. One had exposure to FTX. The other one, Signature, I believe, didn't really have any distress in that sense. And it almost just feels like it was just taken down, baby with the bathwater kind of thing. Mm-hmm. So the interesting thing that has been sticking out to me and what I've been studying is with regards to biology saying that they're blocking the exits. And that's an interesting concept when you think about from a government's perspective, when their currency is under threat. And this kind of happened in 1933, right? During the FDR era, where we were on the gold standard, and the government decided that if our currency was being threatened, meaning people are losing confidence in the value of the dollar, which means that they're going to try to find ways out of it, right? And at the time, there probably aren't many ways out of it. You can either trade into other currencies, or you can trade it into gold, which is, at the time, the best recognized form of money and store of value. So the government basically banned gold, which sounds crazy. I mean, this is only 90 years ago, but it sounds crazy that the government would ban gold and then seize it. And so they basically paid you what they decided was a fair rate on that day. They seized all the gold. They locked it up in Fort Knox. Then they were safely, so effectively blocking the exits, right? Like there's no place for you to go, but you're kind of stuck with the dollar, and all the people around you are stuck with the dollar, and that kind of isolates your economy. Then they're able to print, more and debase the dollar without you being able to exit, because if the dollar is being debased and people are exiting, that's like a burning building and people are pouring fuel on it on the way out, right? But today we have many more options because we live in a globalized world. We have other assets we can go into. We have Bitcoin we can go into.
Bitcoin. Yeah.
And the way into Bitcoin is through our banks, right? If you want to convert your dollars, you have to connect to an exchange, buy Bitcoin. So it makes sense to me that if you are the Fed and you're in a place where you're like, okay, we've been in a low interest rate environment for a long time. Inflation is a threat. We have to start raising our interest rates to combat inflation. So they start doing that. That breaks something. The Fed only has that tool, right? They can increase or decrease the price of money and increase or decrease the amount of money. And so when inflation's going up, they're like, we need to cool it. We need to reduce the amount of money and increase the price of it to slow the speed at which it travels through the economy. And they can kind of do that gingerly until something breaks. And in the past, if the mortgage market breaks, or if personal credit cards, something like that breaks, that's fixable. That's not a big deal. But if it's breaking at the consumer banking level, where now it is giving people pause about whether their money is safe in a place that they otherwise never questioned was safe, that presents a huge problem. And so then the only other option is to start printing again. And if you know that printing is going to cause more inflation, then you really have to protect the exits or block the exits. And that's what I feel like is happening.
Yeah, and it's weird because, and this is exactly what Bitcoin was created for: unconfiscatable, permissionless, immutable, open, public blockchain, meant to exactly fight these kind of situations like what happened with gold that you brought up 90 years ago, which I wasn't even aware of. I guess maybe I was when I was in school, learned how Fort Knox was once created, but I forgot about it completely. But yeah, I mean, that makes perfect sense, looking back at what worked for them in the past and trying to do that again. But now it's impossible to block the exits, or at least much more difficult than it was before. Yeah, you're right. Like Bitcoin is accessible mainly through banks, but there are other ways to attain it, right? OTC through, other methods. But yeah, so it looks like, so what do you guys think is happening now? So now we have like these, so I don't know if the swap lines thing, and when I read this tweet, it's actually amazing. If, for anyone who's watching this and you need help understanding the, really hardcore financial chatter that's going on for people, like I have no idea, swap lines or liquidity provision and global, like I have no idea what that thing said, but I just put it in chat GPT, said, like, please explain this like your 12-year-old. And it was like, okay, so let's say that you and your friends are in these special clubs, right? And they need snacks. You got lots and lots of snacks, but like each different club is like, has their own different snacks, and they're all like, and now you're running low on snacks that you need. And so you can like lend each other different snacks, when you need these snacks to do what you want to do. And like, that's kind of how I was describing this whole like swap lines to different banks. But I did hear a couple people talk about the fact that this will result in money printing, right? And we do know from COVID that was what led us into this, awesome bull run that we saw before. And so, is that what we're looking at now? Are we bullish? Should we be all in crypto?
Yeah. Well, sorry. Well, I mean, it is a kind of money printing. So what I didn't complete there when I was talking about the discount window in explaining that's the Fed buying bonds off the balance sheet of banks for short. It's taking the stuff off the banks in exchange for money. And
so they're buying bad debt.
It was originally called the discount window because they would originally, when it was designed to punish the banks by buying it back at a loss, so that the banks would only use it in an emergency situation. But things have gotten so bad that they've now relaxed that term so that they're buying it back at nominal value. So this is the Fed tried to unwind its efforts to pump money into the economy by stopping buying bonds and starting to sell them, and now that it's having to buy some of them back again because the banks are under duress. So this is an inflationary action. Yes.
So these big boys who are buying this bad debt right now, do they have systemic risk, or are they? What happens?
They are systemically, they're systemic banks. I can't. I mean, just looking at the volumes in that chart, it's such a high peak. I'm sure everybody's getting involved. I mean, I would be careful on the bad debt definition. It's debt that isn't being valued in the current market, but as Brijesh was explaining earlier, if you were to hold it to maturity, it would, the U.S. government continues functioning, it would be okay. It's about if you try and sell it today that you have a problem.
So the idea is that like these smaller banks had these bonds that were marked at maturity, and that's what they were counting as their collateral or their value on hand. Yeah. And then now, because in today's market right now, those are worth, let's say 25, 50, 40% less than their actually maturity date. Yeah. And they need cash right now. So the bigger banks or these kind of union that was formed,
they're precisely the SVB problem. That's right.
They're buying. The bigger banks are buying these bonds temporarily off these guys for the maturity price, and they're saying we have the economic power to hold on to these things to maturity, and it's not going to kill us. I
don't know if it's at the maturity value, but it's not the bigger banks. It's the Fed. The Fed is buying this stuff back off the banks. That's the discount window.
So, and the Fed can only do that by printing money.
It is printing money. It is going. They are raising interest rates to try and cool the market, and then creating this emergency provision that is doing the opposite.
So, crypto bull run.
Well, if people react that way, if enough people can get on board, then yes, we would expect it to pump. Let's see what happens. If enough people come to the conclusion that Bitcoin is safer, that's what we would see.
So, as an economist, what is your thoughts on Bitcoin as a store of value or a peer-to-peer currency compared to gold or fiat?
Look, it is clear Bitcoin's defining feature is cryptographically secured scarcity. you know that thing is on a schedule, and the amount is not going to move off that schedule, and it doesn't matter who you are. Yes, you might talk about concentration of miners and how much hash power it can be, but let's just say, the basic idea is that that's decentralized enough and people can't gang up and game that stuff. So you have something that has a guaranteed scarcity profile in a world where other assets of value no longer have that scarcity relationship. There's a lot more. There are a lot more tokens. So if we already saw this use case proven, we've already seen it proven in countries that have terrible currencies, like Venezuela. Their currency sucked so much that people were already using Bitcoin as a better store of value. Now, the thing is, our other currencies have not deteriorated to that extent. So people have not really understood, had a real immediate practical value for Bitcoin. And but yes, if we ever entered into a true state of hyperinflation, that utility would become relevant and understandable. The reason why, so far we're at 6% inflation, that's stubborn, but it's still much lower inflation rates than we saw in the 70s. So I'm not calling panic just yet. I think I'm hoping that the Fed will stay the course and increase the rate by 0.25. And yes, even though it's tightening with one hand, loosening with the other, we've got to see where it all washes out.
So we hear Elon Musk and Bill Ackman calling for lower interest rates on the Fed meeting. And by the time this thing goes to air, the results will be out. And I guess markets will let us know how they feel about it. But you seem to have a different opinion than Elon Musk and Bill Ackman. Why?
I don't know what reasoning they have behind their views. Labor market data were suggesting that the economy was proving really resilient, and these effects of the higher interest rates were not cooling the economy yet. So some people were expecting a 0.5 point rise, which is very steep compared to the way of things. And people are now saying that this has softened the environment enough. A lot of people are now expecting point rise. So I consider me as someone who's quoting the average MSM, financial MSM opinion when I say that. I think there is a spread. There are a spread of views. Some people think that they might stay neutral. And there's certainly precedent. In the last big tightening cycle that killed the inflation in the 70s, you had some bank failures in the early 80s. And the Volcker, who was chairman of the Fed then, said, we've reached our limit with this tightening cycle. We can't crank it up any further. But this world's really different. So I don't know whether we will find ourselves in a position where the Fed believes they've hit that ceiling, or whether they think, okay, no, this is still sort of manageable. Basically, there are a lot of conversations going on behind closed doors. They have access to a lot of data and conversations that we don't. So, but they're worried and they're keeping an eye on things.
Do we know today yet which banks are calling for bailout, but for basically for them to be able to offload their bonds to the Fed? Do we know how much value that is, and how many banks are going to be affected by this?
Oh, that discount window chart has I'm pretty sure it has a dollar value attached to it. But yeah, I don't know that off the top of my head. These are very significant volumes of sums of money.
Trillions of dollars.
Yeah, definitely. Yeah, billions. I don't know. I can't remember off the top of my head, but yeah.
Close to 200 other regional banks that might be affected materially in the same way. And if you're the Fed, or if you're a bank CEO, or if you're a politician, you're going to be very thoughtful about how you say this.
Yeah,
because,
of course.
You've got to come up with a new name for printing money, which they've done reliably every 5 or 10 years. This is like a new fancy term for it. And you're going to hear a lot about how our financial system and banking system is resilient. And, you want to be very, very thoughtful, because there's a significant psychological component here of just confidence in money. The other thing I wanted to point out was that when we're thinking about what to expect from an interest rate meeting, from an FOMC meeting, or whether they're going to raise rates or lower rates, there are these other components of I think a lot of economists would say that the CPI or inflation numbers that we see, are like subjective, right? Like they, to put it lightly, like they take a lot of creativity, a lot of creative latitude in how they formulate this number, because it's a very public facing number. It's a very politicized number. It's a platform number where if inflation is coming down, the average person is going to feel it at the gas pump or in the price of their eggs, and that's going to determine how they vote. And so it's very important for somebody at the end of a cycle or right before an election to get on the television and say, well, our administration is amazing at running the economy, and we were able to bring inflation down from 6% to 4% or whatever it was, right? There's that. The other thing is, a lot of economists, I think, are saying, I'm just learning about all this stuff, by the way, is that a lot of, like CPI and inflation indicators have a lag, 6 to 18 months from what I've read, which means that the CPI number we see today or last month, the 6%, is actually an indicator from, it's like driving in your car and getting your speed from an hour ago, right? It's from 6 or 12 months ago, which means that if you see 2 of those, then inflation is trending down. And realistically, we could be at 3 or 4% inflation today. But the problem is it's very hard to sell that number to a voting base. But the evidence that that might be true is that the markets price this in, right? Like the equity markets bottomed, call it 6 to 12 months ago, right? Which means that they understand, they can kind of see ahead. And if you want a real-time indicator of where we sit with this stuff, just look at the markets and the pricing. So there are all these different layers that the Fed is kind of working with when they're making this decision. Is how is it going to land politically? How is it going to inform the political cycle? And then what's actually happening? So these are all things to consider.
Yeah, I'll support you in those points. Like inflation indices are not well understood. They are very much a very constructed measure. But at the same time, it would get into the news if the Fed was tweaking the inflation index as it went along. So the index we have is still the index we've been working with. But yeah, I agree with the fact that it's very political, and there's a lot of subtlety there that a lot of people don't appreciate. Yeah. And that there's lag in this data as well. And also there's lag in the way which parts of the economy experience inflationary pressure, right? So there's not just lag in the data, but there's lag in terms of how that's going to then propagate through other sectors of the economy. So reading this data is certainly not straightforward. Lots of
guys,
detail.
it's been awesome. Truly, really, really informative. I've learned a lot. Thank you guys so much for coming on, explaining this to me. And now I feel like I have an understanding what is going on. Very much more clear than I did before. Really appreciate it. Real fast, right before we end it, price of Bitcoin by the end of the year.
You go first, Rodrigo.
Why are we both so quiet here?
I think anybody who has been
I'll go first. I've already cast myself as being part boomer here, so I'll go 35.
Woo! That is
35.
Low. Wow. Okay.
I like 50K. I mean, I think anybody who has been following Bitcoin for a while, it's like surprises at every turn, right?
Yeah.
When it bottomed at $3,500 right before the pandemic, I don't think anybody expected it to moon. A couple of weeks ago, or a month or two ago, we were still recovering from FTX, and we kind of knew we were in for a long haul bear market. It's just so hard to know, and I think that's the beauty of Bitcoin, is it constantly demands of us to rethink of our markets and how we think about money and value. And so I'm just here to be present with it, but I think 50K feels pretty good by the end of the year.
Yeah, I'll throw my guess in at all-time highs. And with that, guys, thank you so much. And this is a pleasure. I hope we can do it again. I'll see you guys later.
Pleasure.
Thanks,
Thank
guys.
you, Kyle. Be well.
Take care. Bye.